Hey there, Lincoln here from boacademy.org. Today let's talk about the IPO Pop. In a previous video we talked about the initial public offering and how it works and why companies undergo this process to become publicly listed on stock exchanges. But now I want to talk to you about what happens on the day of the IPO and how it affects companies going forward. What if I told you that on the very first day that a company is publicly listed, they lose millions of dollars to the process? This is exactly what happens due to the IPO Pop. The IPO Pop can be good or bad depending on who's looking at it, but in most cases, it hurts the company that's going public. Historically, the price of a company's stock on its IPO day tends to pop or go up in value. This means that the company's stock was way undervalued because investors are willing to pay more than what the stock is priced at. In this video, let's talk about how we get to the IPO Pop and how much companies leave on the table when the IPO Pop happens to their stock on their IPO day. We've covered exactly how the IPO process works in a previous video, so if you don't understand how it works, you should go watch that video and get a deep understanding of what the IPO process is and how companies become public going through that process. But here's a quick summary of how that works. In the traditional IPO process, a company enlists the help of underwriters, which are investment banks, to help them complete the IPO process and become a publicly traded company. In the process, the underwriters help the company prepare its S-1s and other regulatory documents and tell its story and pitch to institutional investors. Through this process, institutional investors get an opportunity to buy the company's stock at a discount before other investors get to buy in on the IPO day. So this process might seem like it works for everyone, but there's a big problem here. The problem is the underwriters, the investment bankers, do not actually work for the company that's going public. Instead, they work on the behalf of the institutional investors, their clients. There are three main stakeholders in the IPO process: the company going public, the investment bankers that underwrite the IPO, and institutional investors who invest in pre-IPO shares of the company. See, the underwriters here are investment banks, and investment banks have businesses to run and customers to please. The bank's main customers are the institutional investors, and the service that they provide to the institutional investors, their clients, are greatly discounted shares of the company that they underwrite the IPO of. Because the institutional investors invest a large sum of money into the IPO of the company before the company is publicly listed, the institutional investors want to get a large return on their investment. That means that their goal is to get the pre-IPO shares of the company at an undervalued rate. On the other hand, the company wants to raise as much money as possible from its IPO. That means that they would like to sell their shares to the institutional investors for as much money as possible, or at least close to the fair market value of the company's stock. Then there's the underwriters. They have the tough job of pleasing both sides, the company going public and the institutional investors. The underwriter, the investment bank, wants to maintain their good name with their institutional investors, but also with future IPO companies. If they want to get future business from IPO companies going public in the future, they have to please the current company that they're taking public. But they also need to please the institutional investors because they will continue to come back to buy future pre-IPO shares from them. So how does the underwriter balance these competing interests? They take advantage of one last interest of the company. While the company wants to raise as much money as possible, they also want to ensure the long-term success of the company on the stock market. That means that the company cares more about successfully getting to the public market than getting the perfect price for their stock on IPO day. This gives the underwriter much needed wiggle room. Furthermore, because a company usually only goes public once, the underwriter likely won't have to work with them again on an IPO. That means that the underwriter doesn't have to worry about losing the company as a future repeat customer. But institutional investors usually go back to the same investment banks to buy pre-IPO shares of companies going public, which means that the underwriters, the investment banks, care a lot about pleasing the institutional investors so that they can incentivize them to continue to come back to the same underwriter over and over again to buy pre-IPO shares of companies going public in the future. So all of this gives the underwriter more reason to prioritize the interest of the institutional investors over the interest of the company that they're helping take public. And with that, the underwriter can promise the institutional investors great returns on their investment if they buy the pre-IPO shares of the company's stock during the roadshow. So all of that means that the underwriters can promise the institutional investors great returns on their investments for buying pre-IPO shares of the company at a steep discount. So that's how the underwriters satisfy the needs of the institutional investors. But how do the underwriters make their own money? The underwriters also buy the pre-IPO shares of the company at a similar discount, and they make their money on the spread between what they bought at and what the value of the stock is on the IPO day and after the fact. So all of that leads to the IPO pop, a surge in the price of the stock on the IPO day. So that's great for the institutional investors, that's great for the underwriters, the investment banks, and the company's public. But what does the company get from the IPO pop? The company gets a sense of success on their IPO day as perpetrated by the media. The media loves to see IPO pops, and they consider IPO pops a big win for companies. Of course, that's not the case because that's the whole point of this video. IPO pops cost the companies a lot of money. Then there's the public investors who get very excited about the company because they experience immediate gains on their investments in the IPO of the company. And of course, their gains are due to the hype around the IPO day and the expected IPO pop. It's really all a self-fulfilling prophecy. But this hype and excitement from public investors creates loyal investors for the company going forward, which is a good thing. And of course, all of the hype creates FOMO, fear of missing out among investors, so that creates more hype and excitement for the company going forward. While all of that may be good, the company loses something very important. Hey there, thanks for watching this video. It took me a long time to put together, so if you're enjoying it, like the video below, subscribe to the channel, hit the notification bell, and comment what you're learning so far and what your thoughts are. It really means a lot to me and it helps the channel grow. So thank you for staying engaged and thank you for helping the channel grow, and let's get back to the video. They lose a great amount of money, which is the whole point of this fundraising event. The IPO is a fundraising event. A big point of it is to raise money for the company, to raise as much money as possible for the company to fund its future success. But through this whole process that leads to the IPO pop, a lot of the money that could have been raised for the company is stolen by the underwriters and institutional investors who bought pre-IPO shares of the company for a steep discount to what it's actually worth on the stock market. So the company leaves millions and millions of dollars on the table, and the underwriters and institutional investors make a lot of money from the IPO pop. So the company ends up being a big loser in its own IPO day. So that's how we get to the IPO pop and what the company loses and what the other parties involved gain from the IPO pop. So now let's talk about the solutions. To avoid the whole IPO process altogether, the company could do a direct listing and list existing shares of their company on the stock market without issuing or selling new shares. That means that they can avoid the whole process that leads to the IPO pop that ends up screwing them out of a lot of money on their fundraising day. And they can still get to the public market and then go on to raise money in the future from follow-on offerings. And there are many other alternatives like the Dutch auction that Google opted for in 2004, but they have not caught on because the IPO process is entrenched. Tradition dies hard even if it costs you lots of money. Okay, we're almost done, but before we get to the end, we have to look at some examples to make sure that we understand how this actually works. So say a company going public sells its 5 million pre-IPO shares to institutional investors for $20 per share, raising $100 million for their IPO. Then, on the day of their IPO, their stock price rises to $30 per share. That means that their stock experienced a 50% pop on their IPO day. That would also mean that they lose out on $50 million that they could have raised if they had sold their shares to institutional investors for $30 per share rather than $20 per share, which is what the public market valued the company's stock at on the IPO day. Just to recap, the company sold 5 million shares to institutional investors for $20 per share. Then, public investors said, hey, this company's stock is worth $30 per share on its IPO day. That led to a 50% pop of the share price for that company on its IPO day, which cost them $50 million that they could have raised otherwise. So that's a very basic example of the IPO pop. So let's look at some real examples from this year in 2020 of how much money companies have lost during their IPO due to the IPO pop. According to the Marker publication, of the 61 companies that have gone public this year as of July 23rd, 2020, the median company that went public experienced a IPO pop of 20%. That means that their stock price was undervalued by underwriters by 20%. Put the loss of those 61 companies together from their IPO pop, and you will get $6.7 billion that was left on the table by those companies due to their IPO pop. That means that those companies together could have raised $6.7 billion more than they did in their IPOs this year. That's a lot of money to leave on the table. That was just 1 year, half a year. We aren't even through the whole year yet. And if you look deeper at that, you will see that the median company left $44 million on the table, and that the average company of those 61 companies that went public this year left $110 million on the table. $110 million. That is a lot of money that those companies could use to fund their operations, especially during a pandemic and companies are going bankrupt. That's a lot of money that underwriters and institutional investors ran off with. So in conclusion, companies going public are losing lots of money to the IPO pop. While there may be good that comes out of it all, companies are very clearly leaving lots of money on the table, while underwriters and institutional investors make off with a lot of money. There are a few alternatives to the IPO process, but they have not caught on yet. The direct listing is great, but it doesn't allow companies to raise funds in that initial event. So they have to wait before they can raise more money once they become public through the direct listing. We will talk more about the direct listing later, but that is one alternative that is catching on. And there are other alternatives that we will cover in future videos. So if you're interested in all of this and learning more about the IPO process, then don't forget to subscribe to the channel and hit the notification bell so you know exactly when we publish those videos. Thanks for taking the time to watch this video and understand what the IPO pop is and how it costs companies money that they could use to fund their operations. If you enjoyed it, like the video below, subscribe to the channel, hit the notification bell, and comment below what your thoughts are on the IPO pop and underwriters and institutional investors and what you think about the alternatives to the IPO process. And if you would like to help this channel grow and reach more investors and get direct answers to your questions on investing, then consider joining our Patreon community for just $12 per month, and you will get direct access to me and priority access to request videos that you would like me to cover in the future. And of course, you will get merch such as stickers and mugs and t-shirts in the future, and you will have a chance at winning $200 every month for being a loyal and engaged patron. So I'm Lincoln with BoAcademy.org. Thank you again and have a great day.